It's the first edition of Business Incorporated for the week. Thank you for joining us on the program. I am Bolaji Akiwale. Today on the show, the 20th edition of the African Securities Exchanges Association holds in Kigali, Rwanda. Global markets mixed as oil prices, dollar strength weigh in. Plus, Zimbabwe's central bank set to roll out new bond notes. We'll begin with the markets, this time in Asia, where the Japanese benchmark closed lower after 7 straight sessions of gains as the yen rose sharply against the US dollar and oil prices slipped. Japan's Nikkei 225 closed down 0.13% at 18,356.89. The weakness in the Japanese benchmark is likely owing to yen strength, which is seen as a negative for Japanese export-oriented stocks. Australia's ASX 200 finished 0.79% lower, weighed by weaknesses in its energy and materials sub-index. In China, the Shanghai Composite finished up 0.46%, while the Shenzhen Composite closed down 0.14%. Hong Kong's Hang Seng climbed 0.9%. Last Friday, China and Hong Kong securities regulators announced that the Hong Kong Shenzhen Stock Connect would kick off on December 5. This trade link would allow foreign investors to trade Shenzhen stocks from Hong Kong. And in Europe, the markets were lower as well in morning trade amid continued political uncertainty in Italy and fading hopes of an OPEC production cut, which pushed oil prices lower. Janelle Dumoulin is DWTV financial correspondent, joining us from the Frankfurt Stock Exchange. Janelle, it's great to have you on the show. Now, major European equities are in the red this Monday. Gold prices rising and US dollar trending lower on fear that OPEC will not be able to implement Algiers' decisions on output cut. How bitter are investors about this uncertainty? Is it likely to continue for the rest of the week?
You know, it may very well could, and it really depends on the signals that will come out of the OPEC summit in Vienna that will start on Wednesday. Now, so close to the meeting, it's not looking very good because tensions are flaring up. Iran and Iraq have both expressed doubts as to the mechanics of a potential production rollback, and Saudi Arabia attracted a lot of attention last week with its remarks on Russia. Like just ahead of the meeting, so close to the meeting on Wednesday, Saudi Arabia pulled out of another summit with Russia and other non-OPEC members who are also oil-producing nations, saying that it doesn't make sense to meet them before internal clarity has been achieved within the OPEC. So that is bringing the deal a bit into doubt. Now, the move is thought to be strategic in order to force Iran and Iraq to agree to the freeze and to agree to cut quotas. But of course, still, these remarks put pressure on the oil price, and we saw it sink by as much as 4% last Friday. Now, over the weekend, Saudi Energy Minister Khalid Al-Falih said that the oil markets would rebalance anyway, even without a deal. And because he said something like that, that makes it appear like a deal to cut back on production is further away than we thought.
Now, the upcoming French election is gathering steam with the emergence of the Republican Party candidate François Fillon making a win in the presidential primary. What is the sentiment today at the markets regarding Fillon's emergence?
You know, investors have generally been welcoming of François Fillon's reform-mindedness. He said, for example, that he wants to scrap the 35-hour work week in France, and we know this is a bit of a sacred cow in the French labor market, so that takes a bit of bravery to say that. And he also wants to cut the wealth tax and cut corporate tax by to 25%. From the 34.4% that we have now, which is, by the way, the second highest rate of corporate tax in the European Union. So companies are welcoming these reforms. On the other hand, reforms are always a bit of a mixed bag, and they're also looking at other plans, like the plans to increase value-added taxes, like the plans to cut 500,000 public sector jobs, and they're worried what that might do to domestic consumption and the overall domestic economy if people don't have enough liquidity to spend on the economy. Now, but Fillon's potential presidency is generally seen as a move towards more stability in the Eurozone if it would head off the election of the more far-right Marine Le Pen. And the potential of a Fillon presidency coupled with the presidency the chancellorship of Angela Merkel in Germany could be seen as signs that two Eurozone economies are at least steady at a time where a lot of risk factors threaten the bloc.
Now, speaking specifically to Germany, two of the largest companies are still in the news for the wrong reasons, Volkswagen and Lufthansa. Any idea from how soon the troubles of these firms will go away?
Indeed, lots of troubles there for those two companies that you just mentioned. Now, Lufthansa pilots are, of course, set again to strike this week after talks had failed. So we're going to see strikes tomorrow and on Wednesday. Now, that's going to be the 15th strike in just 2 years. So as to your question of whether we will see a speedy end to all of this, well, that just hasn't looked like the likely outcome for a while. And also, Lufthansa is also taking quite a deep financial hit as a result of all these strikes. Like looking back at 2014, we know that the pilot strike cost Lufthansa 222 million euros, and the year after that, 2015, the combined strikes of pilots and cabin crews cost Lufthansa even more, 231 million. Just last week, we had a 4-day strike, and those first 2 days alone already cost 20 million euros. So even if they do this, end up resolving this labor dispute with the pilots, then the problem will be, first of all, the financial hits that I also mentioned and the long-term damage to Lufthansa's brand. Now, we know that this airline makes most of its money from its long-haul flights, and it's precisely those passengers that have the most incentive to stay away from Lufthansa, and they may avoid taking Lufthansa in the future, and of course that will be a problem.
Thank you so much.
As for Volkswagen, it is still working through its Dieselgate crisis, its emissions scandal, and one of the ways that it's doing that is it's banking very heavily on electric vehicles. But even that is proving a bit contentious. Reuters, for example, is reporting that there have been some in-house conflicts between Volkswagen and its premium brands Audi and Porsche as to which factories and which companies will produce this new generation of electric vehicles. And this is all happening at a time where Volkswagen is facing a massive restructure with 30,000 jobs on the line, and obviously it still has to pay out the costs of the scandal. It set aside $18 billion, but analysts are even estimating that it could run up to 30. So both in dealing with the mistakes of the past and looking for ways to move the company into the future, Volkswagen looks like it certainly has its work cut out for it.
Thank you so much, Janelle Dumoulin, DWTV financial correspondent reporting from Frankfurt.